What if I told you that the entire future of artificial intelligence, like the pristine digital cloud-based revolution that is supposed to change absolutely everything about how we live and work, is actually entirely dependent on companies capturing toxic, rotten egg-smelling gas deep in the West Texas dirt?
I mean, it sounds like a joke, right? But it's completely true.
Today, we are looking at this crazy collision. We're looking at the digital world crashing headfirst into the heaviest, grittiest physical infrastructure on Earth.
Yeah, and it really is a profound disconnect in how we view the modern economy. Like, we spend all day looking at screens, we're thinking about software, cloud computing, algorithms.
Right.
But the underlying reality is that the digital realm requires an exponentially increasing amount of physical energy. And the story of how that energy is extracted, treated, and moved, it's far more complex than just watching a simple ticker symbol go up or down.
Exactly. And that is exactly our mission for today's deep dive. We are taking something that is traditionally viewed as one of the driest, most jargon-heavy events in the corporate world.
Oh, absolutely. The dreaded Wall Street earnings call.
Right, the earnings call transcript. And we are tearing it down to the studs because hidden inside these corporate transcripts are the actual literal blueprints for how the physical world operates.
They really are.
So we have our hands on the Q4 2025 earnings call transcript for a massive midstream energy operator called MPLX.
And look, this particular transcript is a goldmine, because MPLX sits squarely at the intersection of several massive global paradigm shifts.
Yeah, it's not just pipes.
Not at all. We are looking at the staggering power demands of the AI data center boom, for one, plus the geological aging of U.S. shale wells, which is, and we'll get into this, fundamentally altering the chemistry of what comes out of the ground.
Which is fascinating.
And of course, the rapidly shifting global energy alliances.
Right. But before we go any further, let's establish exactly what a midstream company is, because I think people, they easily confuse them with the drillers.
Oh, all the time.
If you picture the overall energy sector, the upstream companies are the ones out there surveying the land, right? Punching holes in the ground, pulling the raw hydrocarbons to the surface, taking all that risk.
Yeah, the exploration guys.
And then the downstream companies are the utilities powering your house, or the gas stations where you fill up your car. MPLX is the midstream. They are the invisible network connecting the two.
Literally the middlemen.
Exactly. They're the massive pipelines, the compressor stations, the multi-billion-dollar processing plants, and the export terminals on the coast.
They essentially act as an incredibly sophisticated toll booth. I mean, they do not explore for oil. They don't take on the geological risk of drilling a dry hole.
Right. They aren't gambling on finding oil.
No, exactly. And they aren't selling the final product to the consumer either. They literally just charge a fee to move a physical molecule from point A to point B, and they charge another fee to process that molecule along the way, so it is actually in a usable state.
Which makes their earnings calls so fascinating to me, because their financial health is a direct proxy for the physical flow of energy across the continent.
The cash flow tells the truth.
It does. So if we want to understand that flow, we need to look at the scoreboard for the year that just ended. We need to see if this company is actually delivering the cash or if it's all just, management spin.
Always a valid question.
So let's look at the 2025 scorecard. And we're going to be very data forward today because the numbers in this transcript are, frankly, massive.
Yeah, they really are.
For the full year of 2025, MPLX reported that their adjusted EBITDA crossed the $7 billion mark. $7 billion. And they returned $4.4 billion directly to their unit holders.
I mean, those figures alone tell you that the volume of product moving through their system is immense. But for anyone listening, we need to translate how they actually get to those numbers.
Yeah, break down the jargon.
So anyone who follows macroeconomics or the markets knows what EBITDA is, right? Earnings before interest, taxes, depreciation, and amortization. It's basically a standard measure of operational profitability. But the critical word in their report is adjusted EBITDA.
Right. And I have to say, I always have my guard up when management teams use adjusted metrics.
Oh, sure.
It often feels like a really convenient way to sweep bad decisions under the rug. Like, hey, if you ignore the hundreds of millions we lost on this failed project over here, our core business looks great.
Yeah.
Why should we trust their adjusted numbers?
Well, listen, you should always maintain that skepticism. But in the specific context of the midstream sector, looking at unadjusted numbers actually distorts reality.
Okay, how so?
Because midstream companies own incredibly expensive tangible assets. We are talking about pipelines that cost billions of dollars to lay in the ground, processing complexes that take years to build. Under standard accounting rules, a company has to depreciate the value of those massive assets over decades.
Right, the accounting rule book says the pipe is getting older, so it's losing value.
Exactly, which means they are forced to take a massive paper loss on their income statement every single year.
But the pipeline itself is still sitting there in the dirt. Yeah. It's completely functional, moving gas and generating cash every single day.
Precisely. The depreciation is an accounting fiction. I mean, it's designed to map out the lifespan of the asset, but it has zero impact on actual cash hitting the company's bank account on a Tuesday afternoon.
Ah, okay.
So when MPLX reports adjusted EBITDA, they are stripping out those massive non-cash accounting penalties. They are trying to show the market the true recurring cash generated by the physical toll booths.
Okay, that makes total sense. We're trying to find the actual cash velocity of the business. And that brings us to the second major metric they highlight, which is distributable cash flow, or DCF.
A very important one.
Right. They reported $1.4 billion in DCF just for the fourth quarter alone. And this is the metric that matters most to the retail investor, right? Because this is the money left over after they've paid all their operating expenses and their maintenance bills to keep the pipes running safely. This is the pile of cash sitting on the desk that management can legally hand back to the investors as a dividend, or as they call it in the structure, a distribution.
Yeah, and that cash pile is the ultimate barometer of a midstream company's health. If DCF is growing, the physical footprint is generating excess value, period.
But I want to pause right there.
Yeah.
Because I spotted something in the micro view of their Q4 numbers that completely contradicted the broader growth narrative.
Oh, you mean the segment dip?
Yes. For the fourth quarter of 2025, their natural gas and NGL services segment, which is the core of what we are talking about today, saw its adjusted EBITDA actually decrease by $10 million year over year.
Right.
I have to play the skeptic here. In a year where management is doing a massive victory lap over $7 billion in overall earnings, their core gas segment shrinks in the final quarter.
Right.
Are the pipes drying up? I mean, is the demand narrative fraying at the edges?
Look, if you just skim the top-line press release, it absolutely looks like a miss. It looks bad. But when you dig into the actual transcript, the CFO, Chris Hagenhorn, provides the context that changes the math entirely.
Okay, lay on it.
During that specific quarter, MPLX strategically divested about $23 million worth of what they call non-core gathering assets.
So they sold off a chunk of their pipeline network.
They did, because in the midstream space, you constantly evaluate your portfolio. If you have an older gathering system in a region where drilling activity has permanently slowed down, or say it doesn't connect efficiently to your larger long-haul pipelines, it becomes a drag on your overall return on capital.
You're spending maintenance money on an asset that isn't growing.
Exactly. So they sold those underperforming assets. They intentionally shrank their footprint.
Ah, okay, I see the math now. If you carve out that $23 million hole from the assets they sold, the actual core business that they chose to keep didn't shrink at all.
Exactly right. When adjusted for that divestment, the core retained business actually grew by 2.1% year over year in that quarter.
Wow.
Yeah, so it wasn't a demand issue or an operational failure. It was a deliberate pruning of the tree to make the overall organism healthier.
That really highlights the danger of just reading the headline numbers. And, there's another slight dip in the fourth quarter that caught my eye. We mentioned that $1.4 billion in distributable cash flow.
Right.
That number was actually down 4% compared to the previous year. But looking at the balance sheet, that drop wasn't from a lack of revenue. It was driven by higher interest expenses. They've been acquiring new assets to fuel future growth, and they financed those moves with some new debt.
Yeah, the cost of capital is a massive factor for midstream operators, and we will definitely get deeper into their balance sheet later. But what you need to take away from the 2025 scorecard is the confidence signal management sent.
Which was huge.
Massive. Despite those minor quarterly accounting fluctuations, MPLX achieved its fourth consecutive year of a mid-single-digit growth streak. And because of that massive recurring cash generation, they didn't just promise future returns, they instituted a 12.5% bump in their distribution to unit holders.
A 12.5% raise, a double-digit percentage raise in the cash they hand out to investors.
Yeah.
I mean, that is not a decision the board of directors makes lightly.
No, you only authorize a 12.5% recurring distribution bump if you possess absolute mathematical certainty that your pipelines are going to be completely full for the foreseeable future.
Right.
It is the ultimate signal of forward-looking confidence.
Which begs the critical question, right? What are they seeing on the horizon that makes them so confident? Why did the CEO, Marianne Mannon, announce they're planning to deploy another $2.4 billion in growth capital in 2026 alone?
That's the real story.
To answer that, we have to transition to the macro story.
Yeah.
We need to look at the demand side of the equation.
And this is where the narrative shifts from the granular financial plumbing of a single company into massive global megatrends.
Totally. Because there is a specific projection in this transcript that made me completely reevaluate my understanding of the energy landscape. Management explicitly stated they project United States natural gas demand to grow by over 15% between now and 2030.
15% is massive.
It is. Now, put that in context. Every single day, the headlines are dominated by the energy transition, right? We are reading about solar panel efficiency, massive offshore wind farm investments, electric vehicle adoption mandates. The entire global narrative is about transitioning away from fossil fuel.
Right, that's what you hear on the news.
So a 15% surge in natural gas demand over the next 5 years seems entirely contradictory to the prevailing wisdom.
Well, it is contradictory to the consumer-facing narrative, but it perfectly aligns with the industrial and technological realities on the ground. Look, there are two distinct massive engines driving this 15% surge.
Okay, what's the first one?
The first is geopolitical. It's the explosive growth of liquefied natural gas, or LNG, exports.
Ah, right. We've seen Europe completely sever its reliance on Russian pipeline gas over the last few years.
Exactly. And that energy void had to be filled immediately to keep their industrial base from collapsing. The United States has rapidly stepped in to become the world's primary gas station.
Because we have so much of it.
We have an ocean of it. We are chilling our domestic natural gas to minus 260 degrees Fahrenheit, turning it into a liquid, putting it on massive specialized ships, and sending it to Europe and Asia. That global thirst is pulling a tremendous amount of supply out of the domestic market.
But the domestic driver is arguably even more fascinating to me because it ties directly into the technological revolution we are all living through right now. The transcript points to the skyrocketing power needs of artificial intelligence in data centers.
Yes. And people tend to conceptualize the cloud or AI as something ethereal and weightless, right?
Yeah, it's just in the air.
Exactly. You type a prompt into an interface, and a second later, an incredibly complex answer appears. It feels like magic. But the physical reality behind that magic is a massive, sprawling server farm operating thousands of highly specialized graphics processing units, or GPUs.
And I think we really need to quantify this because the scale is hard to grasp. When we talk about an AI data center, we aren't talking about the power draw of a large commercial office building. We are talking about grid-level electricity consumption.
It's unbelievable. To train a large language model, you need continuous, uninterrupted power at an astronomical scale. Some of these planned gigawatt-scale data centers require the equivalent electricity of a medium-sized American city.
Wait, a single facility demanding the power of a city like San Francisco?
Literally, yes. And here's the brutal engineering constraint. These data centers require 100% uptime. The GPUs cannot flicker. The cooling systems cannot shut down for an hour.
Because if the power supply drops, the training run crashes, and millions of dollars in compute time are instantly vaporized.
Yes, exactly. Which exposes the fundamental limitation of renewable energy in this specific application. You cannot power a gigawatt-scale AI data center solely with solar or wind. Because what happens when the wind stops blowing at 2:00 a.m.?
Or weather system blocks the sun for 3 days.
Right. The grid requires what engineers call baseload power. Uninterruptible, 247 highly responsive power generation that does not care about the weather. Currently, the only two viable ways to provide gigawatt-scale baseload power with a relatively clean emissions profile are nuclear and natural gas.
And the tech companies are certainly trying to invest in nuclear. We see headlines about them trying to restart old reactors or invest in small modular reactors.
They are, definitely. But building a brand new nuclear power plant from scratch in the United States requires navigating over a decade of bureaucratic and regulatory hurdles, not to mention billions of dollars in upfront capital. The tech industry moves in months, not decades. They cannot wait 10 years for power. So natural gas wins by default. It is the only baseload fuel that can be deployed fast enough and at the necessary scale to satisfy the immediate demands of the AI arms race. That is why demand is surging 15%.
So the expansion of the digital mind fundamentally requires the expansion of the physical natural gas footprint. That perfectly explains the massive demand. But the transcript didn't just focus on the demand side. It also highlighted a major shift in how the supply is coming out of the ground.
The geology is changing.
Yeah, the CEO mentioned a changing gas-to-oil ratio in the major shale basins. I want to unpack the geology here because understanding the physical mechanics of a fracked well explains why MPLX has such a structural advantage right now.
Oh, this is fascinating. The changing gas-to-oil ratio is arguably the most important long-term tailwind for midstream operators. And it all comes down to the deep earth physics of hydraulic fracturing.
Let's trace the life cycle. When an exploration company first leases land and drills a new well down into a major shale basin like the Permian Basin in Texas, what are they primarily looking for?
In a basin like the Permian, the primary target is almost always liquid crude oil. Crude oil is the prize because it commands the highest price per barrel on the global market. That is what drives the drilling economics.
Okay.
When a new well is fractured, the initial underground pressure in the reservoir is immense.
I imagine it like shaking up a bottle of soda and then popping the cap. The pressure forces everything up the pipe.
It's a very apt analogy. And because the pressure is so high early on, it easily forces the heavier, viscous liquid crude oil through the microscopic cracks in the shale rock and up to the surface.
Right.
So in year one, the well produces a very high ratio of valuable oil compared to natural gas.
But the shale revolution really kicked off over a decade ago. We now have an entire generation of wells that are aging. What happens to that underground physics as a well enters year 5 or year 10?
The fundamental dynamic changes. As millions of barrels of liquid are removed over the years, the immense pressure inside the reservoir naturally drops.
The soda bottle is losing its fizz.
Right. As the pressure declines, the heavier liquid crude oil becomes much harder to push through those tiny fissures in the rock. The oil production curve flattens out and declines.
But the well isn't empty.
Far from it. This is where the molecular size becomes critical. While the heavy crude oil struggles to flow at lower pressures, natural gas molecules are significantly smaller and lighter.
Ah, they can still escape.
They can still migrate easily through the rock. So as the well ages, it starts to gas out. The ratio flips. The well produces less and less crude oil and a massively increasing relative volume of what the industry calls associated gas.
And in these specific basins, this associated gas isn't just pure dry methane that you can immediately burn in a power plant, right? It's much more complex.
Oh, it is incredibly wet gas. It is heavily saturated with natural gas liquids, or NGLs. These are heavier hydrocarbons mixed in with the methane, things like ethane, propane, butane, and natural gasoline.
And this geological shift creates a massive problem for the driller, but a massive opportunity for MPLX. Think about it. The driller who spent millions of dollars aiming for high-margin crude oil is now suddenly overwhelmed by massive volumes of this wet associated gas.
And they don't want it.
Right, and because of environmental regulations, they can't just burn it off in a flare or vent it into the atmosphere. They were legally obligated to capture it and move it.
But the upstream driller has zero desire to spend $1 billion building a complex chemical processing plant to separate the methane from the propane. That is not their core competency. So what do?
They pick up the phone and call the midstream operator.
Exactly, because MPLX has intentionally positioned its massive processing infrastructure squarely in these aging, highly prolific basins. This natural geological phenomenon, this rising gas-to-oil ratio, acts as an automatic growth engine. Even if the drillers slow down their deployment of new drilling rigs, the existing aging wells are constantly forcing higher volumes of gas through MPLX's toll booths.
The natural decay of the Earth's reservoir pressure literally forces more product into their cash register. It's a brilliant structural advantage. Okay, so armed with that understanding of why demand is surging from AI and why supply is shifting from aging wells, We need to look at exactly where MPLX is deploying their capital.
Right, the geography matters.
The transcript highlights their operations in the most famous oil patch on the continent, the Permian Basin in West Texas.
The Permian remains the absolute beating heart of the American energy resurgence, but the infrastructure required there is evolving.
Yeah, MPLX is executing a very specific strategy in the Permian that caught my attention. The transcript details their recent acquisition and aggressive integration of a sour gas treating operation.
This is a great move by them.
They are currently constructing a massive facility called the Titan Treating Complex, which is designed to process 400 million cubic feet of gas per day by the end of 2026. But why is a company known for moving energy intentionally buying into sour gas?
Whoa.
To use an analogy, it feels like they are intentionally buying the only commercial hazmat cleaning facility in a town full of chemical factories.
Yep.
The factories don't want to deal with the toxic waste, so if you own the only facility capable of neutralizing it, you essentially hold a localized monopoly. You can dictate the terms.
That analogy is incredibly precise because sour gas is essentially a hazardous material. Let's look at the mechanics of it. When natural gas comes out of the ground relatively pure, mostly just methane with some light liquids, the industry calls it sweet gas. It requires standard processing, but it's relatively easy to handle.
Okay, sweet gas is good.
Right. However, in certain specific windows of the Permian Basin, the gas is designated as sour because it emerges heavily contaminated with hydrogen sulfide.
Hydrogen sulfide. That is the highly toxic compound that smells like rotten eggs, right?
Yeah. Yes. The smell is nature's warning system because hydrogen sulfide is lethal even in very small concentrations. But from an infrastructure and engineering standpoint, the toxicity isn't even the primary challenge.
It's not.
No. The critical issue is that hydrogen sulfide is extraordinarily corrosive.
So you can't just hook up a standard steel pipeline to the wellhead and pump the sour gas away to a distant refinery.
If you pumped untreated sour gas into a standard carbon steel pipeline, the hydrogen sulfide would literally eat the metal from the inside out. You would suffer catastrophic pipeline integrity failures, leaks, and blowouts in a matter of months.
That explains why the upstream drillers want absolutely nothing to do with it. But how does MPLX actually neutralize it? The transcript mentions amine units. What is the actual mechanism at play inside a facility like the Titan complex?
It requires intense chemical engineering. When the raw sour gas enters the Titan facility, it is fed into the bottom of a massive contactor tower. As the gas flows upward, a specialized liquid chemical and amine solution is sprayed down from the top. The amine molecules act like chemical magnets. They specifically bind to the toxic hydrogen sulfide molecules, pulling them out of the gas stream. The natural gas, now sweetened and safe to handle, exits the top of the tower.
And what happens to the toxic stuff?
The amine liquid, which is now heavily saturated with the toxic sulfur, drops to the bottom and has to be routed to a regenerator. There, it is boiled to release the sulfur for industrial disposal so the amine can be recycled.
That sounds like an incredibly expensive, capital-intensive process to build and maintain. I mean, you need specialized metallurgy that won't corrode, complex chemical handling systems, and highly trained engineers.
It costs hundreds of millions of dollars. But going back to your hazmat analogy, that immense upfront cost is exactly the point. It is the definition of competitive moat. The producers operating in that specific sour window of the Delaware Basin are pulling up massive volumes of highly valuable hydrocarbons, but the product is trapped. It is worthless and dangerous until it is treated. If MPLX commits the massive capital to build the only state-of-the-art sour gas processing complex within a 50-mile radius, those producers have absolutely no alternative.
They can't walk across the street to a competitor because no one else is willing to spend the capital to handle the toxic headache.
Exactly. The producers are completely captive. This allows MPLX to negotiate ironclad long-term contracts with extremely favorable toll rates. They take on the hardest operational and engineering challenge in the basin specifically to eliminate competition.
And the earnings call proves that this strategy is working flawlessly because management announced a brand new project right on the heels of Titan. They are calling it Secretariat II. It's a $320 million processing plant expected to deliver mid-teens returns.
Another massive investment.
But what truly stood out to me about Secretariat II is the timeline. They are committing hundreds of millions of dollars to this infrastructure project, but it isn't expected to come online until the second half of 2028. They are planning 3 full years in advance.
That 3-year lead time exposes the unforgiving reality of the physical midstream business. In the software world, if demand spikes, you can spin up new cloud servers in an afternoon. In the physical energy world, you cannot react on a whim.
It's physical dirt and steel.
Great. If a major upstream producer looks at their geological surveys and decides they're going to drill 50 new wells in a specific county starting in 2028, the processing plant and the pipeline network have to be physically constructed, tested, and waiting the exact moment the drill bit breaks the surface.
Because if the processing capacity isn't there, the driller is physically blocked. They have to cap the well and leave the capital stranded in the ground.
Exactly. The infrastructure must precede the production. MPLX is constantly analyzing reservoir data, holding deeply integrated planning sessions with the major drillers, and deploying capital years in advance to ensure the physical capacity perfectly matches the future volume.
And this extensive planning ties directly into what management repeatedly referred to as their wellhead-to-water strategy.
Yeah.
Let's trace the physical journey of a molecule of gas through this system, because it really illustrates how they stack their profits.
It is a brilliant masterclass in margin capture. Step 1 is the wellhead. The raw, sour gas comes out of the Permian dirt. It goes straight into the Titan or Secretariat complexes.
Coal Wolf number 1.
Exactly. MPLX charges a toll to strip out the toxic hydrogen sulfide and separate the raw stream into pure methane and natural gas liquids. But that is just the first toll booth.
Right. Now you have clean, separated products sitting in West Texas. But the demands for those products is primarily on the coast, hundreds of miles away.
So step 2 involves moving the product. The transcript highlights how MPLX connects these processing complexes directly into their massive downstream pipeline expansions. They explicitly discuss the Bengal pipeline and the Blackcomb pipeline projects.
These are the big ones.
These are the high-pressure interstate highways designed to take the clean gas and liquids out of the basin, cut across the massive state of Texas, and deliver them to the Gulf Coast. MPLX charges a second toll for the long-haul transportation.
And when the gas finally reaches the Gulf Coast, what happens at the water end of the strategy?
At the coast, the product enters MPLX's massive fractionation facilities and export terminals. The mixed natural gas liquids are further separated into pure, commercial-grade propane and butane. They are chilled, loaded onto specialized maritime shipping vessels, and sent to international markets.
So they charge more tolls.
They charge a third toll for the final fractionation and a fourth toll for loading the ships at the dock.
It is total vertical integration of the midstream process. I mean, if a competitor only owns a gathering pipe in Texas, they get paid once. If another competitor only owns an export dock in Louisiana, they get paid once.
Yeah.
By controlling the entire physical journey from the dirty, toxic wellhead in the Permian to the pristine export ship floating in the Gulf of Mexico, MPLX captures a margin at every single phase of the molecule's life.
They stack the returns on the exact same physical product 4 different times. And crucially, by owning the entire value chain, they ensure that their massive long-haul pipelines are never empty. The gathering and processing plants they own in the Permian act as a guaranteed funnel, constantly feeding volume into their own downstream network.
It is a beautifully enclosed loop. Now, the Permian strategy makes total sense because they are capitalizing on that complex toxic sour gas moat and the liquid-rich geology. But that raises a massive question for me. If so much of their competitive advantage relies on stripping out oil byproducts and toxic chemicals, what happens when they operate in a basin where there is very little oil or sour gas to begin with? Which brings us to the Northeast United States.
Ah, the Marcellus.
The Marcellus Shale Formation is actually MPLX's largest single operating region, and the geology there is a completely different beast.
It is. The Marcellus, which stretches beneath Pennsylvania, Ohio, and West Virginia, is one of the most prolific natural gas basins on the entire planet. But unlike the Permian, it is overwhelmingly a pure natural gas play. The product coming out of the ground is predominantly dry methane.
Which means the sour gas mode doesn't apply here. So we have to look at how they manage pure volume. And there was a specific metric regarding their Marcellus operations in the transcript that honestly gave me pause.
The utilization rate.
Yes. Management stated that their Marcellus processing utilization rate sat at 97% for the quarter. 97%.
It is an incredibly high operational metric.
But I want to push back on this being purely positive. Think about any other physical industry. If I am running a specialized manufacturing plant or a global shipping logistics network, and I am operating at 97% of my absolute maximum capacity, I am terrifyingly close to a systemic failure.
You're running at the red line.
Exactly. The supply chain is stretched so tight it's about to snap. I have zero slack in the system to accommodate a sudden surge in orders, meaning I am actively turning away new customers. How is running a massive high-pressure industrial pipeline network at 97% a good thing?
It is a completely valid concern in almost any other sector. But the midstream pipeline business operates on a totally unique set of economic principles regarding operating leverage. In this specific industry, 97% utilization is the absolute dream scenario, and it comes down to the ratio of fixed costs versus variable costs.
Break down that ratio for me. How does it work?
Think about the massive capital required to lay hundreds of miles of 36-inch steel pipe through the Appalachian Mountains. It costs billions of dollars in steel, welding, labor, and environmental permitting. That is your fixed cost.
Right. You pay for the pipe once.
Once that pipe is buried and pressurized, the actual variable cost to operate the electricity for the compressors, the maintenance crews, is relatively flat. It costs roughly the same amount of money to operate the pipeline, whether it is 50% full or 90% full.
So the infrastructure overhead is essentially locked in on day one.
Precisely. So if your pipeline is only running at 50% capacity, you are barely covering the massive debt and depreciation of the fixed construction costs. But as you push more volume through the system, your costs barely budge while your toll revenue skyrockets.
Yeah, I see.
When you reach 97% utilization, you are achieving maximum revenue efficiency. Almost every single molecule of gas flowing through that final 5% of capacity is generating pure profit that drops straight to the bottom line. It proves that the massive asset you built is perfectly scaled to the actual demand of the basin.
Okay, I see. The margin profile on that final 5% is astronomical because the pipeline is already paid for. But my original point still stands. What happens when a producer wants to drill more wells? You are at 97%. The pipe is effectively full. You have to tell the driller no, which is a cardinal sin if you want to maintain long-term relationships.
You are absolutely right, and that is the operational tightrope they walk. The solution to being at 97% capacity is massive targeted expansion. This is what the industry calls debottlenecking the system.
Right.
And the transcript detailed their primary solution for this, which is Harmon Creek III. This is a massive new processing complex designed to handle 300 million cubic feet per day, scheduled to come online in the third quarter of 2026.
When Harmon Creek III flips on, management noted it will bring their total Northeast processing capacity to a staggering 8.1 billion cubic feet per day. Let's just pause on that number to appreciate the scale. 8.1 billion cubic feet of natural gas every single day. The volume is almost incomprehensible.
It highlights the sheer scale of the energy required to power the modern economy. And it is a perfect example of just-in-time infrastructure management. They let the existing Marcellus system ride up to that highly profitable 97% red line, but they time the construction of Harmon Creek III so it comes online right at the exact moment the existing system hits 100%.
Oh, wow.
They maximize the profit of the old system while seamlessly opening the valve to the new one, never having to turn a customer away.
It requires an unbelievable level of forecasting precision. But there was another Marcellus project mentioned that I found even more fascinating from an engineering perspective. Management detailed a $450 million gathering expansion project. And what intrigued me wasn't just the price tag, but the specific mechanism of the expansion.
The compression strategy.
Yes. They are adding compression to the pipeline system to actively help the drillers. Let me try to explain the physics here. You tell me if I have this right. Natural gas essentially moves through a pipeline based on pressure differentials, right? Mm-hmm. It naturally wants to flow from an area of high pressure to an area of low pressure.
That is the fundamental fluid dynamic at play, yes.
So when a driller taps a brand new well in the Marcellus, the natural pressure of the gas deep in the rock is incredibly high. That high pressure easily pushes the gas up the wellbore and forces it into MPLX's gathering pipeline. It's like blowing air into an empty balloon. The gas just rushes in.
Right.
But as that well ages over several years, the underground formation pressure naturally declines. Eventually, the pressure coming out of the wellhead drops so low that it can no longer overcome the ambient pressure already inside the MPLX pipeline. The gas physically cannot push its way into the pipe. The balloon is already full, and the well can't blow hard enough.
That is a perfect visualization. At that point, the gas simply stops flowing. The well is shut in, even though there's still plenty of valuable gas down there.
So historically, to solve this, the upstream driller would have to go out and spend millions of dollars of their own capital to buy, install, and maintain giant gas-powered compressors right at the wellhead to artificially force their gas into the pipeline. This massively increases the driller's cost of production.
It eats directly into their profit margins and forces them to manage complex rotating equipment that they would rather not deal with.
So here is the brilliant part of the MPLX strategy. Instead of forcing dozens of different drillers to buy their own small compressors, MPLX spends the $450 million to build massive, centralized compressor stations directly on their own gathering system. These giant compressors actively suck the gas out of the lateral lines, which effectively creates a low-pressure vacuum in the pipes right near the aging wellheads. They artificially lower the pressure of the pipeline.
Exactly. They drop the line pressure from, say, 800 psi down to 300 psi. Suddenly, the aging wells that only have 400 psi of natural pressure can flow freely again.
It instantly brings the dead wells back to life without the driller having to spend a single dime on new wellhead equipment. It extends the productive lifespan of the driller's assets.
It is the ultimate symbiotic relationship in the energy sector. The drillers realize a massive expansion in their profit margins because their operational costs drop and their old wells start generating revenue again. In exchange for solving this massive engineering headache, MPLX secures ironclad long-term volume commitments from those drillers.
They get guaranteed volume.
The drillers guarantee they will push X amount of gas through the system for the next 10 years, which mathematically guarantees MPLX those mid-teens returns on the $450 million they just invested.
They aren't just selling pipeline space. They are selling a highly engineered service that fundamentally lowers their customers' cost of doing business. It is a win-win that locks in decades of loyalty.
A very smart business model.
Okay, so we have traced the complex journey of this energy. We've watched them capture the toxic sour gas in the Permian and utilize advanced compression physics to suck the dry gas out of the Marcellus. We have brought a massive volume of product to the coast. Now we have to look at what happens when these molecules leave the United States, because the end market demand is what ultimately drives the entire machine.
This is the moment where MPLX transcends being a vital piece of domestic infrastructure and becomes a critical node in the global macro economy.
The centerpiece of their global strategy is the massive export terminal they are currently constructing on the Gulf Coast. It is a 400,000 barrel per day LPG export terminal expected to come online in 2028. And this specific project sparked one of the most revealing exchanges during the earnings call.
During the Q&A, right?
Yes. During the Q&A segment, an analyst named Manav Gupta pushed back against management's narrative. He pointed out that multiple infrastructure companies are currently building export docks on the Gulf Coast. He essentially asked, aren't we risking massive overcapacity? If everyone builds an export terminal, aren't we going to have too much supply capability and not enough global demand to keep the ships full?
A fair question.
But in the very next breath, he pivoted and asked about the potential impact of a recent India-US deal.
It was an incredibly sharp two-part question from the analyst because he is evaluating the ultimate bottleneck of the entire global supply chain.
But before we dive into how the CEO dismantled his overcapacity fear, we need to clarify exactly what product we're talking about. People hear gas export and they immediately think of LNG, liquefied natural gas. But this terminal is specifically designed for LPG. What is the distinction and why does it matter on a global scale?
It is a vital chemical and economic distinction. LNG, or liquefied natural gas, is primarily pure methane. Methane is an energy fuel. It is what you burn in a power plant to generate electricity for an AI data center, or what you burn in a furnace to heat a home in Berlin during the winter.
Okay.
LPG, on the other hand, stands for liquefied petroleum gas. This is primarily composed of your heavier natural gas liquids, propane and butane.
Now, when the average person hears propane, they think of the small white tank they buy at the hardware store to run their backyard barbecue grill.
And that is a localized consumer use. But on the macroeconomic global scale, propane and butane are so much more than just heating fuels. They are the foundational chemical building blocks for the entire global petrochemical industry.
Really?
They are the primary feedstocks used in complex cracker facilities to manufacture plastics, synthetic rubbers, advanced packaging, medical devices, automotive components. Virtually the entire physical architecture of the modern consumer world is derived from LPG.
So exporting LPG isn't just about providing energy to keep the lights on. It is about providing the raw, physical materials necessary for developing nations to build their modern infrastructure.
Exactly. And the reason this export terminal is so critical for MPLX ties all the way back to the deep earth geology we discussed earlier. Because of the aging shale wells and that rising gas-to-oil ratio, the United States energy industry is currently producing an absolute glut of propane and butane.
Too much of it.
We are pulling so much LPG out of the ground in Texas and Pennsylvania that the domestic American manufacturing market physically cannot absorb it all. We have far more feedstock than we can ever use.
So it is absolutely imperative that it leaves the country.
It must be exported. If the LPG cannot be exported, the entire midstream supply chain backs up, the storage tanks fill up, the processing plants have to halt operations, and eventually the pressure backs up all the way to the wellhead, forcing the upstream drillers to stop producing crude oil.
The whole system shuts down.
Therefore, a massive export terminal on the water is the ultimate bottleneck asset. It is the final gatekeeper that allows the entire domestic energy machine to keep running.
That perfectly explains the supply side. Okay. MPLX knows the domestic producers are desperate to get this LPG onto ships. But what about the analysts concerned on the demand side? What happens if they build this massive terminal and there is no one on the other side of the ocean willing to buy it? How did the CEO, Marianne Menine, address this fear of overcapacity?
Her response was a masterclass in macroeconomic forecasting. She completely bypassed the short-term noise of competing dock construction and pointed the analysts straight toward the unstoppable demographic trends of global petrochemical demand.
Yeah, interesting.
She focused on developing economic superpowers, specifically pointing to the analysts' mention of India. As a nation like India continues its rapid economic ascent, hundreds of millions of people are entering the middle class.
And as a population enters the middle class, their per capita consumption of physical goods transforms.
Radically. A rising middle class demands modern appliances, packaged consumer goods, automobiles, advanced medical care, and modernized urban infrastructure. Every single one of those demands requires a massive, sustained increase in the consumption of plastics and synthetic materials, which in turn requires an unquenchable supply of propane and butane.
She is betting on the inevitable math of human development.
Exactly. She addressed the India-U.S. trade discussions by noting that while the geopolitical negotiations are still in the early stages, the underlying thesis is undeniably strong. Nations like India are looking decades into the future. They want to secure reliable, uninterrupted, long-term supplies of these critical chemical feedstocks to guarantee their industrial growth.
And we have the supply.
And the United States, utilizing the massive scale of operators like MPLX, is the most stable and prolific provider of LPG on Earth. Management's view is that the macroeconomic demand for physical goods will so thoroughly outstrip global supply that when this terminal opens in 2028, the docks will be running at absolute maximum capacity from day one.
It is truly staggering to think about the interconnectedness of it all. A decision made by a driller to tap a specific rock formation deep under the dirt of West Texas is ultimately validated by the expansion of the middle class in Mumbai. The MPLX pipeline is the physical steel thread that ties those two vastly different worlds together.
It's the global economy in action.
Okay, I am feeling incredibly bullish on the structural narrative we've uncovered. They have a massive moat, brilliant engineering strategies, and macro-demographic tailwinds. But as the hosts of this deep dive, it is our responsibility to look for the cracks in the foundation.
Always.
We have to look at the downside risks, the regulatory threats, and the financial plumbing of the balance sheet. Let's move into our final segment, capital discipline and what could go wrong. Because if everything is so perfect, how is management actually protecting the downside? Let's start with a highly technical regulatory risk that an analyst brought up during the call.
Regulatory risk is the constant shadow hanging over the midstream industry, so we absolutely must analyze it.
An analyst asked management about a specific impending headwind from the FERC index change to PPI minus 0.6%. Now, I read financial documents all day, but that sentence is incredibly dense.
Yeah.
Let's translate this. I know the FERC is the Federal Energy Regulatory Commission. They are the U.S. government agency responsible for overseeing interstate commerce in the energy sector.
Right.
Because a massive pipeline is essentially a natural monopoly. I mean, you can't practically have 5 different companies build 5 competing pipelines right next to each other. FERC steps in to regulate exactly how much a midstream company is legally allowed to charge their customers for the toll.
That is exactly right. FERC acts to protect the upstream producers from being price gouged by the midstream monopolies. They establish a legal ceiling on the toll rates. However, FERC also recognizes that a pipeline company has rising operational costs, labor, materials, electricity. To ensure the midstream operators don't slowly go bankrupt as their costs rise, FERC ties that toll rate ceiling to a standardized inflation index. Specifically, they use the Producer Price Index, or PPI.
Okay, so if the cost of doing business goes up, FERC allows the pipeline to raise its tolls accordingly. But they review this mathematical formula every 5 years. And the new formula they just announced is that pipeline rates can increase by the rate of PPI minus 0.6%.
Yes.
Let me just do the basic math on that. If general industrial inflation, the PPI, is running at 2% for the year, MPLX is only legally allowed to raise their pipeline rates by 1.4%. That sounds like a structural mathematical nightmare for profit margins. Your underlying costs are rising by 2%, but your revenue is artificially capped at a 1.4% increase. Over a decade, that negative index modifier will slowly, inevitably, crush your operating margin. Is this a systemic threat to their entire $7 billion cash flow?
Well, look, if you look at the formula in a vacuum, a negative index modifier is undeniably a margin crusher. It means the pipeline's regulated revenue is actively falling behind the curve of inflation. But to assess if it's a systemic threat, we have to look closely at the specific context provided by Sean, the executive who answered the question.
What did he say?
He quickly diffused the tension by making two very distinct critical points.
Walk me through the defense.
First, he emphasized that the midstream industry is not caught off guard. FERC doesn't make these decisions in secret overnight. The entire sector knew a negative modifier was highly likely in this specific 5-year review cycle. MPLX possesses a massive team of financial analysts, and they had already baked this lower revenue assumption into their long-term, multi-year financial model.
It was priced in.
Exactly. It wasn't a sudden shock that blew a hole in their budget. It was a known variable they had already accounted for.
They saw the regulatory punch coming from a mile away and braced for the impact. That shows good management. But what was the second point?
The second point completely neutralized the threat. He provided the exact operational exposure. He explicitly stated that this specific FERC index regulation only applies to their crude oil and liquid products logistics pipelines.
Okay.
Furthermore, within that specific liquid segment, only about 33% of the contracts are actually tied to the index. The rest are negotiated at market rates. So when you zoom out and look at the entirety of MPLX's massive diversified portfolio, including all of the Permian processing plants, the unregulated Marcellus gathering networks, the export terminals, this specific FERC ruling only impacts about 20% of their total business.
That is the critical nuance. 80% of their entire revenue stream is completely immune to this specific regulatory headwind. That changes the narrative entirely. It transforms a terrifying systemic threat into a minor localized annoyance. It will lightly compress margins on a fraction of their assets, but it has absolutely no power to derail their broader strategy or threaten that 12.5% distribution growth.
Precisely. It is a managed risk, not an existential one.
Okay, so the regulatory risk is contained. But let's look at the actual numbers on the balance sheet, specifically leverage and debt. I was reviewing the financial tables at the back of the transcript. They boast a very healthy $2.1 billion in pure cash sitting on the balance sheet.
That's nice cushion.
It is. But Chris Hagenhorn, the CFO, noted that they also have $1.5 billion in senior notes that are maturing in March of 2026. And here is the kicker that concerns me. Those specific maturing notes carry a super low 1.75% interest rate. They took out that debt years ago when global macroeconomic policy essentially made money free to borrow.
It was a brilliant, opportunistic financial maneuver at the time. They locked in massive capital for virtually nothing. But the fundamental law of debt is that the bill eventually comes due.
Right. And now they have to refinance that $1.5 billion in today's macroeconomic environment, where interest rates have normalized significantly higher. They are going to be trading 1.75% debt for debt that might cost 5% or 6%. That is a massive jump in interest expense. We already saw a glimpse of this headwind in Q4, where higher interest payments drag their distributable cash flow down by 4%. If they have to refinance billions at higher rates, won't that massive increase in interest expense just eat away all the cash flow we were celebrating in the first segment?
It is the most common pitfall for infrastructure companies. High interest rates have bankrupted many midstream operators in the past. But this is exactly where MPLX's rigid concept of capital discipline becomes paramount. To understand how they survive higher rates, you cannot just look at the debt. You have to understand their strict, unyielding financial hierarchy.
The capital stack.
Yes. They do not just spend cash haphazardly as it comes in the door. The board operates on a rigidly defined capital allocation framework.
I love frameworks. Let's walk through it. What is the absolute priority when a dollar of toll revenue hits the bank account?
Priority number one, which is absolutely non-negotiable regardless of the macroeconomic environment, is maintenance capital. You must spend whatever is necessary to keep the existing pipelines safe, properly pressurized, and legally compliant with environmental regulations.
Because if a pipe breaks.
If a pipe corrodes and leaks, the regulatory bodies shut you down and the entire business grinds to a halt. You protect the baseline asset first.
Make sure the bridge doesn't collapse before you try to expand it. Makes complete sense. Once the maintenance is paid for, what is priority two?
Priority two is distribution growth. This is the sacred, unbreakable promise they have made to Wall Street and their retail investors. They prioritize paying that steadily growing cash dividend over almost everything else.
That's huge for investors.
That strict prioritization is the only reason management could confidently project maintaining that massive 12.5% distribution growth rate for the next 2 years, despite the rising interest rate environment. The investors get paid before the company expands.
Okay, so the pipes are safe and the investors have their cash. What is priority three?
Priority three is organic growth capital. This is where the $2.4 billion budget for 2026 comes in. This is the funding for the massive debottlenecking projects like Harmon Creek III, the specialized sour gas complexes like Secretariat II, and the global bottleneck assets like the LPG export terminal.
But they don't just build to build.
No, they will only fund these projects if their internal models guarantee a high hurdle rate, those mid-teens returns we discussed. They will not build a pipeline just for the sake of getting bigger. It must be highly accretive to cash flow.
And finally, if they have paid for maintenance, paid the dividend, fully funded their high-return growth projects, and they still have cash left over at the bottom of the barrel.
Priority four is unit buybacks. That is the flexible lever management can pull. If they have excess cash and they believe the market is undervaluing their equity, they step in and buy their own stock to artificially boost the value for the remaining unit holders.
Okay, so that's the 4 steps.
But overriding every single one of these 4 priorities is a strict mandate handed down from the CEO. They are absolutely committed to never letting their leverage ratio, which is the ratio of their total outstanding debt to their total EBITDA, exceed 4.0x.
They will never let their total debt grow to be more than 4 times their annual operational earnings.
Never. In fact, they currently expect that leverage ratio to naturally fall over time as projects like Titan and Harmon Creek III come online and start generating new cash flow without requiring new debt.
Okay, so bring it all back to the refinancing risk.
Right. So, to finally answer your question about the refinancing risk, yes, swapping 1.75% debt for 5% debt will mathematically increase their interest expense. It will cost them millions more. But because they are generating over $7 billion in cash, because they have a $2.1 billion cash cushion in the bank, and because they rigidly cap their total leverage below 4.0x, the balance sheet has immense shock absorption.
They can take the hit.
They can easily absorb that higher interest rate hit without breaking a sweat, without halting construction on their growth projects, and crucially, without compromising their sacred promise to grow the investor distribution by 12.5%. The financial foundation is built on solid bedrock, not a dangerous house of over-leveraged cards.
That is a deeply compelling, numbers-driven defense. It really translates those dry balance sheet metrics into a coherent story of resilience. It is the distinct difference between a company hoping for growth and crossing their fingers on interest rates, and a company engineering their growth with absolute mathematical certainty.
It's all about capital discipline.
Which brings us to the end of our journey today. We have covered a truly massive amount of ground. We started with a stack of seemingly dry, jargon-filled corporate earnings notes. And by stripping away the acronyms and looking at the physical mechanics, we've uncovered an incredible story.
We really have.
We have mapped the anatomy of a company standing as a critical, unbypassable toll booth. On one side, they face America's shifting raw energy supply, the declining pressure of aging shale wells, and the toxic specialized handling of Permian sour gas.
And on the other side?
On the other side, they face the world's ravenous, accelerating energy demand, driven by the hyper-advanced baseload-hungry AI data centers right here at home, and the rapidly expanding petrochemical-thirsty middle classes in developing nations like India.
If we pull all of these complex threads, the geology, the engineering, the geopolitics, and the financial frameworks into a single actionable synthesis, it is this. We currently live in an era utterly captivated by rapid, software-driven digital technological change. We obsess over the virtual.
Yeah, we do.
But the empirical evidence in this deep dive proves that the massive physical infrastructure required to move the underlying energy powering, that digital change is often the most durable, reliable, and lucrative wealth generator in the entire global market.
It's the physical foundation.
MPLX is actively demonstrating that so-called boring steel pipes, specialized compressor stations, and chemical processing plants, when they are positioned at critical geographic bottlenecks and managed with strict, uncompromising capital discipline, yield spectacular financial results. It is the absolute definition of a strong, structurally protected business operating a monopoly on physical reality.
Boring steel pipes yielding spectacular results. That is the perfect summary. And that brings us to the close of our analysis. I want to sincerely thank you for joining us on this deep dive. We spent a lot of time today talking about the digital revolution, the rapid rise of artificial intelligence, the expansion of the cloud, virtual realities, all these abstract concepts that feel completely weightless and detached from the earth.
But they aren't weightless at all.
No. This earnings call reveals a stark, inescapable physical truth. And it's a truth I want you to actively mull over as you go about your day. If the digital world requires an exponentially increasing amount of physical energy to run, if every single AI prompt you type requires natural gas to be chemically stripped from the dirt in Texas, pushed through a high-pressure compressor in Pennsylvania, and burned in a massive turbine just to keep the server farms from going dark, will the tech giants ultimately control the future? Or will the companies that own the physical pipes hold the true keys to our digital existence? Think about who really powers your cloud the next time you log on.